Economists all over the world, including our own chief economist, Dave Bassanese, are expecting a US recession in 2023. It's always difficult to pin down the single cause of a recession, but in this case, it has to do with inflation and interest rates. Interest rates, inflation, and the health of the economy are all interconnected concepts that impact one another. Before we get into this video, let's make something clear. Economics is a complex topic. The economy is the accumulation of billions of consumer decisions made every day. Every time someone buys or sells something, it has microscopic impacts on prices, wages, and people's mortgages. Sometimes it feels like a miracle that these systems work in any sort of functional manner. Let's put things a little more simply. Imagine there's only one central bank in an economy which sets interest rates for everyone. Now let's say that only one good is sold, cheeseburgers. In this example, the cheeseburger is a normal good. The economic definition for a normal good is one whose demand increases as people's income and purchasing power rises. The more money people have, the more cheeseburgers they buy. The less money they have, the less cheeseburgers they buy. In our economy, cheeseburgers are made by the burger store. Inflation refers to the rate at which burger prices increase over time. In general, we can expect to see the price of cheeseburgers increase. In the real world, inflation is measured by using a price index that contains a basket of goods and services. Interest rates are the cost of borrowing money in the economy. The higher the interest rates, the more expensive it is for people to borrow money. Rates are influenced by the central bank, who use them to control the supply of money. Money supply is the total amount of cash in the economy, whether it's banknotes, coins, bank deposits, or short-term cash securities. Now we've established a few rules, let's talk about the relationships within our economy. Interest rates and inflation are closely linked. If interest rates are low, it is cheaper and easier for people and businesses to borrow money. Here's an example. The price of one cheeseburger is $5. If the central bank lowers interest rates, consumers can choose to borrow more money, and they might use it to buy more cheeseburgers. The increased demand for cheeseburgers can lead to price increases because there are only so many cheeseburgers to go around. The burger store makes the choice to price these cheeseburgers now at $6. This is inflation. Consumers can now buy fewer cheeseburgers per day, even though their income is the same. The value of their money is less. On the other hand, if the central bank sets interest rates higher, borrowing costs become more expensive, which can reduce demand for cheeseburgers and lead to lower inflation, or in some cases deflation. In the instance of deflation, cheeseburgers might go from $5 down to $4. We can track the health of our cheeseburger economy by the number of burgers sold. More burgers equates to more productivity. In the real world, this measure is called gross domestic product. Growing GDP is a good thing. It means that technology is advancing, people are consuming and producing more. So back to our burger economy. 2 consecutive quarters of falling burger production means that the economy is now in recession. The central bank might combat recession by lowering rates. When interest rates are low, it can encourage borrowing and spending, which stimulates economic growth. This is a positive thing for the economy. However, if interest rates are too low, it can lead to excessive borrowing and risk-taking. During these periods, the economy's wealth leads to increased consumption and speculative investment. In these circumstances, people start to go a bit burger crazy. They buy as many as they can and start to borrow money to buy extra burgers, hoping to flip them for a profit. Too much speculation can create bubbles in financial markets, which can implode and create a catalyst for a recession, like 2008 GFC or the dot-com crash. But on the other hand, if interest rates are too high, it can discourage borrowing and spending, which can slow down economic growth. The central bank aims to get interest rates into the Goldilocks zone, not too high and not too low, just right. In the Goldilocks zone, people can afford enough burgers to keep them happy, but not so many that prices go up too high. Central banks like the RBA in Australia and the Federal Reserve in the United States can use interest rate targets like a weapon to combat high inflation or spur on economic growth. When inflation runs hot, they can increase rates at the risk of reducing economic growth. And that's exactly what we saw at the end of 2022 and the start of 2023. It's important to note that inflation and interest rates are not the only factors that contribute to a recession in the real world. Other factors such as geopolitical events can also play a major role in causing an economic downturn. However, understanding the relationship between interest rates and inflation and the economy can help people make more informed decisions about borrowing, investing, and spending. If you'd like to stay up to date on movements in inflation and the risk of recession, check out our BetaShares YouTube channel, where our chief economist, Dave Bassanese, gives monthly economic updates. Thanks for watching. We'll see you next time.